Have you ever had 3 losing trades in a row and felt that pressure inside your chest saying, I have to win this next one? That feeling isn't about the market. It's about how your brain handles uncertainty and risk. You start focusing on being right, not on managing risk. And that's exactly how traders lose control. What if you could think differently? What if you could look at a trade, accept the possible loss before entering, and stay calm no matter what happens next? That's how professionals trade. And that's exactly what we're going to build today. Welcome to the Trading Psychology course. In this chapter, we're focusing on risk, reward, and thinking and probabilities. You'll see why thinking in series matters more than predicting a single trade. We'll break down how to define your risk in a consistent way, measure reward through R multiples, and build a mindset that accepts uncertainty. Because this topic is foundational, we'll cover it in 2 parts. Part 1 teaches you to accept risk before the entry, size positions correctly, and think in R instead of dollars. And Part 2 shows you how to calculate expectancy, test your edge across a series of trades, and use a simple tracker to build long-term consistency. By the end of this first lesson, you'll know how to set your risk, read your results in R, and get ready for the expectancy work in Part 2. Before we talk about probabilities, there's one thing you need to understand. You must accept the risk before you enter a trade. I know it sounds obvious, but this single habit separates amateurs from professionals. Most traders click buy or sell because they hope it'll work. Professionals do it knowing exactly how much they're risking, and they've already accepted that amount before they click the button. That changes everything. It turns an emotional decision into a professional one. Accepting the risk means 3 simple things. First, your stop loss is defined by structure, not by emotion. You're not moving it because you feel nervous. Second, your position size matches your account and your stop distance. You're not guessing how many lots or shares to take. And third, the money you're risking is small enough that even if this trade loses, you can take the next one without hesitation. When those 3 pieces fit together, you stop reacting emotionally to the market and start managing exposure like a professional. Let's make this practical. Imagine your account is $10,000 and you decide to risk 0.5% per trade. That's $50 of risk. If your stop is 25 pips, each pip must be worth $2. That's your position size. If your stop is 10 cents on a stock, you adjust the number of shares so a full stop equals those same $50. You're no longer focused on how much you can make. You're controlling how much you can lose. And that single shift is where professional trading begins. See what's happening here? You're removing hope from the process. You're not trying to avoid losses. You're planning for them. Once the risk is accepted before you enter, a stopped-out trade isn't a failure anymore. It's just a planned business expense, something already calculated and expected. You take the loss, log it, and move on with a clear head. That calm state of mind, that sense of control, is what builds consistency. It allows you to take the next trade with full confidence, without revenge, hesitation, or fear. And once you master this mindset, you realize something powerful. Success in trading doesn't start with winning. It starts with accepting losses. Once you've accepted the risk, it's time to change how you measure it. Forget about dollars. Start thinking in R, your unit of risk. 1 R is simply the amount you decided to risk on a trade. If your stop equals $50, that's 1 R. If the trade hits your stop, you lose 1 R. If it moves twice that distance in your favor, you win 2 R. It's simple, but this small change completely rewires how your brain sees a trade. When you think in dollars, every trade feels emotional. A $50 loss feels personal. It stings. Your brain sees it as danger, not data. That's why traders break their own rules after a losing streak. But when you think in R, You detach from emotion. You stop seeing the trade as money lost or gained and start seeing it as part of a process. One event in a larger series where the math matters more than the moment. Here's a quick example. You take 10 trades, each risking 1R. You lose 5 of them, all at minus 1R. And the other 5 you win at plus 2R each. Do the math. 5 losses equal minus 5R. 5 wins equal plus 10R, leaving you with plus 5R overall. You didn't have to predict which trades would win. You just kept your losses small and your winners bigger. That's professional trading. It's not about being right. It's about creating an edge where the size of your winners outweighs your losers. When you use R, everything becomes easier to compare. You can look at setups in Forex, stocks, or crypto and evaluate them in the same language, risk units. One setup risks 1R to make 3R. Another risks 1R to make 1.5R. Instantly, you know which has the better potential. You don't need to think in dollars or pips anymore, just R. So next time you plan a trade, don't say, I'm risking $50 to make 100. Say, I'm risking 1R to make 2R. It may sound small, but it's huge for your psychology. When you think in R, you stop chasing outcomes and start focusing on execution. You stop trading for money and start trading for consistency. And that's where real progress begins. Now that you're thinking in R, it's time for the next mental shift, from predictions to probabilities. This is where real traders separate themselves from dreamers. Most people enter the market trying to guess what will happen next. They look at a chart and think, this trade has to work. But professionals don't think that way. They know no single trade defines them. Their results come from how their edge performs over a series of trades. Prediction thinking sounds like, this setup looks perfect. It's definitely going to win. Probability thinking sounds very different. This setup fits my rules. I'll take it, accept the risk, and let my edge show up over the next 20 trades. Feel the difference? One is emotional and attached to a single outcome. The other is calm, logical, and focused on the long game. That shift alone can save you years of frustration. Think of a simple coin flip game. Heads, you win 2R. Tails, you lose 1R. You'll lose often, sometimes 5 or 6 times in a row, but the math is still in your favor. Even with a 40% win rate, you'll end up profitable because your winners pay more than your losers cost. That's trading, a game of probabilities, not predictions. Your job isn't to win every flip. It's to make sure your reward is always larger than your risk. And to play enough rounds for the math to work. Once you understand that, everything changes. You stop obsessing over one trade. You stop thinking, I need to win now, and start thinking, I need to follow my plan consistently. You stop reacting to every candle and start managing your system. The moment you do that, emotions lose their control over you. You stop trying to be right and start aiming to be consistent. And that's what makes you profitable. If your system has a positive expectancy, meaning your average trade result is positive over time, then you don't need to stress about any single outcome. One trade is meaningless. 20 or 50 trades reveal the truth. That's where probabilities live. Each time you follow your plan, you give your edge a chance to work. Each time you break it, you interrupt the math that could have helped you. This is what Mark Douglas calls thinking in probabilities. He said that traders who accept uncertainty stop fearing individual outcomes. They know anything can happen, but they trust their edge to play out. That trust gives them calm confidence, the kind that lasts even after losses. So from now on, stop asking, will this trade win? And start asking, does this setup fit my plan? If it does, take it, manage the risk, and let the math do its job. One trade doesn't matter. What matters is the series, the repetition, and your discipline to stay in the game long enough for probabilities to reward you. Every trader loves winning streaks, but what truly tests your mindset are the losing ones. No matter how good your strategy is, drawdowns are inevitable. You can have a solid edge and still go through 5 or 6 losses in a row. That's not failure. That's statistics at work. The real question isn't if you'll face a losing streak, but how you'll handle it when it happens. Let's put this into perspective. Suppose your system wins 40% of the time. That means you'll lose 6 out of 10 trades. Losing streaks will happen regularly. It's part of the game. What makes the difference is your risk per trade. If you risk 2% and lose 6 in a row, you're down around 11%, enough to shake your confidence. But if you risk only 0.5% per trade, that same streak costs you about 3%. It's uncomfortable, but manageable. That's the power of small risk. It keeps you calm and in the game long enough for your edge to show up. Most traders overlook this. They obsess over entries, indicators, and patterns, but ignore the psychology of preservation. Professionals think differently. Their main goal isn't to make money fast. It's to stay in the game. Risk management isn't about being cautious. It's about being realistic. The smaller your risk, the easier it is to stay detached from any single outcome. The less you panic, the better you execute. And that calm execution is what compounds into long-term growth. Think of trading as a long series, not a single event. You're not trying to win today. You're trying to stay consistent over hundreds of trades. Every time you cut your risk, you buy yourself more chances for your edge to appear. That's why professionals think in terms of R, not dollars or emotions. They even set daily or weekly loss limits, like stopping for the day at -3R, or for the week at -6R. Those boundaries protect both their money and their mindset. So next time you hit a losing streak, don't panic and don't double your size. Remember, drawdowns are part of the math. Step back, breathe, and remind yourself. Small risk equals freedom. Freedom to take the next setup, to stay disciplined, and to let probabilities do their work. That's how professionals survive long enough to win. Now that you understand risk, let's talk about the other side, the reward. This is where many traders lose focus. They plan stops with precision, but set their targets on hope. They think, maybe price will keep running, or I'll take profit when it feels right. That kind of thinking kills consistency. In professional trading, reward isn't emotional. It's logical and based on what the market is likely to do, not what you want it to do. Every target should have a reason: structure, liquidity, or key price levels. For example, you can place your take profit near a previous high, a fair value gap, or a supply and demand zone. Those are logical areas where price often reacts. That's where professionals take profits. You don't pick random numbers. You let the chart tell you where it makes sense to exit. It also helps to scale out in partials using R multiples. You might take a portion at +1R to cover costs, another at +2R to secure gains, and leave a smaller part running toward +3R or the next liquidity pool. This keeps your balance between safety and potential. You're protecting capital without cutting winners too soon. And over time, that habit keeps your emotions stable and your equity curve smooth. The key idea is simple. Your average winner must be bigger than your average loser. If you risk 1R and only make 1R, you'll need to be right more than half the time just to grow, and that's tough. But if your average winner is around 2R, you can be wrong more often and still end up ahead. That's the math behind consistency. A positive expectancy, where your average gain per trade beats your average loss, turns trading from luck into logic. Remember, your edge doesn't come from prediction. It comes from asymmetry, risking little when you're wrong and making more when you're right. That's why professionals don't chase massive wins or dream of doubling their accounts overnight. They focus on small, structured gains repeated with discipline. Because over time, the math always rewards patience. The traders who last aren't the ones who dream big. They're the ones who plan smart. So before every trade, ask yourself, is my target logical? If it's not, adjust it. Trade with structure, trade with reasoning, and let the probabilities take care of the rest. When both your risk and reward are planned with precision, emotion loses its power, and consistency becomes your true edge. Let's bring everything together with a few quick examples so you can see how these ideas look in real trades. Imagine an uptrend where price pulls back to a strong structure level. You take a long entry, placing your stop below the last higher low. That's your 1R of risk. Price respects the zone, builds momentum, and hits the previous high. You take profit at plus 2R. One clean trade just paid for 2 normal losses. That's how professionals use math to win. Not by being right every time, but by keeping risk fixed and letting reward breathe. Now imagine the opposite. You short a breakdown in a weak market, but news hits and price spikes against you. It hits your stop. You lose 1R, just as planned. No panic, no revenge trade, no moving the stop. You log it, take a breath, and wait for the next setup. Because you accepted the loss before entering, it doesn't damage your confidence. It's just one trade in a long series. The next valid setup appears, and you take it calmly. That's real consistency. Emotion-free repetition of a tested process. These examples might sound simple, but they show the biggest difference between amateurs and professionals. The amateur reacts to every result like it's life or death. The professional treats each trade as part of a larger probability game. They focus on discipline and controlled exposure, the real factors that keep the numbers in their favor. You'll find this mindset in almost every great trading psychology book. Mark Douglas, in Trading in the Zone, says real confidence comes when you stop expecting certainty from an uncertain market. The market doesn't owe you a win. It only offers probabilities, and your job is to manage them with discipline. Van Tharp expands on this with his work on R multiples and position sizing. He shows that measuring results in R helps you see clearly if your edge is working and keeps emotion out of performance. Both Douglas and Tharp share the same truth. You can't control outcomes, only behavior. And when your behavior aligns with the math of risk and reward, consistency follows. You might not win today, but over the series, the math takes care of you. That's the mindset you're building. Trading probabilities, not emotions. Now it's time to put this lesson into action. Knowledge means nothing if it stays in your head. It has to reach your trading routine. So here's a simple but powerful exercise that will help you start thinking like a professional risk manager. First, choose your fixed risk per trade. Keep it small, something between 0.25% and 1% of your account. Write that number down. If your account is $10,000 and you pick 0.5%, that means every trade risks $50. That's your 1R. This number is your anchor. It defines how much you are comfortable losing without emotion. Next, pick one setup you already use. It could be a pullback entry, a breakout, a liquidity grab, anything you trade often. Go back to 3 recent examples on your chart and mark your logical stop and your logical target. Don't guess, use structure. Now measure the distance between them and express it in R. If your target is only 1R, that setup may not be worth taking unless it wins a very high percentage of the time. If your target is 2R or more, That's a healthy balance of risk and reward. The goal is to train your brain to see trades not in dollars, but in risk units. Then, create a short statement you'll say before every entry this week. Something like, I accept a full loss of 1 R on this trade. My stop is based on structure. My position size is correct. If I lose, I'll record it and move on. It might sound simple, but this sentence has power. It forces you to take ownership of your risk before you enter, and that habit builds emotional control. And finally, try this optional drill. It's called the coin flip exercise. Grab a coin and simulate 30 flips on paper. Every time you get tails, write down -1 R. Every time you get heads, write down +2 R. Track your running total as you go. You'll notice that even after several losses in a row, the total eventually turns positive. That's what probability looks like in action. You're not trying to win each flip. You're trusting the math across the series. That's the mindset you need as a trader. Do this exercise seriously for 1 week. It will rewire how you think about trading. You'll stop obsessing over a single outcome and start focusing on process, discipline, and consistency. And that's the foundation for everything that comes next. If there's one thing to take from this lesson, it's this. You can't control outcomes, but you can control risk. Once you accept that truth, the market stops feeling like chaos and starts feeling like a probability game. One you can finally play with confidence. From now on, start every trade with the same mindset. I know my risk, I've accepted it, and I'll follow my plan. When you think in R instead of dollars, fear and ego disappear. You stop trading to be right and start trading to be consistent. That's how professionals approach the market. Calm, disciplined, and patient enough to let the math work for them. In part 2, we'll go deeper into probabilities. You'll learn how to calculate the expectancy of your strategy, track your results across a series of 20 trades, and see, in numbers, whether your system truly has an edge. It's the missing piece that transforms theory into measurable confidence. So don't skip this step. Do the exercise, practice thinking in R, and learn to accept risk as part of the game. Once you do, trading feels lighter, and your results begin to reflect your new mindset. See you in part 2, Expectancy and the Mathematics of Consistency. Please also remember that you're not alone on this journey. All the material in this course was developed by the ComLucro channel, built on thousands of hours of trading experience and enriched with knowledge from books, lectures, and videos you can also find here on our channel. I invite you to explore our other courses and learn from the insights of world-class traders and coaches like David Paul, Alexander Elder, Tom Hugard, Mark Douglas, Al Brooks, Larry Williams, and many others we study and share here. And in the next module, we'll go even deeper to help you understand trading decisions and how to align your mind so it works for you, not against you. I hope you enjoyed today's video. If you found the content helpful or engaging, please give it a like, as this helps the video reach more traders like you. And don't forget to subscribe to the channel and turn on notifications so you never miss our latest insights on the markets and practical trading strategies. Sharing this video with your friends or on your social networks can make a big difference and helps our community become stronger. Now, if you want to go even deeper and get access to exclusive content, early video releases, and extra tools to support your journey, consider becoming a member of the ComLucro trader community right here on YouTube. It's a way to support our work and a smart investment in your own development. Thanks for watching, and I'll see you in the next video.